The US government just made silver national security. On October 24th, 2025, a classified report landed on the president's desk. Silver, along with 40 other minerals, suddenly became a threat to national security, not because of what it is, but because of where it comes from and who controls it. The proclamation mentioned something most people missed: minimum import prices, price floors, export controls. When governments start bidding against markets, someone always pays the price. The question is, will it be them or you? Welcome to Currency Alert. Now, if you've been around long enough to remember when a handshake meant something, when business was done on trust, not algorithms, then you understand the value of being ahead of the curve, not chasing it. We don't post videos for noise. We post them for signal. So if you appreciate straight talk about money, markets, and what's really moving behind the curtains, do yourself a favor. Hit that subscribe button. Think of it as reserving your seat at a table where the real conversations happen. And before we dive deep into what this proclamation actually means for your wallet, your business, and your future, tell us in the comments, where in the world are you watching this from? Are you in the States, Europe, Asia, somewhere else entirely? Because what's about to unfold affects everyone differently. Now, let's get into it. October 24th, 2025 marked a quiet turning point in American economic policy, one that most media outlets missed entirely. On that date, the Secretary of Commerce transmitted a report to President Trump, a document that would fundamentally redefine how the United States views silver and dozens of other materials. The language was precise, almost bureaucratic, but the implications were anything but ordinary. According to the report, processed critical minerals and their derivative products were being imported into the United States in such quantities and under such circumstances as to threaten to impair the national security of the United States. Not economic security, not industrial competitiveness, national security. That distinction matters, because when something becomes a national security issue, the rule book changes entirely, markets get overridden, supply chains get weaponized, and prices stop behaving like prices. The proclamation laid bare a vulnerability that Washington had been quietly tracking for years. The United States, the world's largest economy, the center of global finance and innovation, found itself dangerously dependent on foreign sources for the very materials that power modern civilization. 12 critical minerals, 100% import reliant. 29 more, over 50% import reliant. 41 materials in total, each one essential, each one increasingly scarce. And silver sat right in the middle of this strategic crisis. 69% of America's silver comes from abroad, primarily from Mexico, a single source responsible for roughly a quarter of global supply. But here's where the problem deepens. Even where the United States has domestic mining capacity, it lacks the processing infrastructure to convert raw ore into usable industrial material. Think about that for a moment. A nation can pull silver from the ground within its own borders, but still must ship it overseas to be processed, then import it back as a finished product. It's the equivalent of growing wheat, shipping it to another country to be milled into flour, then buying back your own bread. Inefficient, vulnerable, and strategically indefensible. The proclamation didn't mince words about why these minerals matter. National defense, critical infrastructure, advanced weapon systems, energy infrastructure, consumer electronics, vehicles. Every single one of these sectors depends on materials the United States cannot reliably secure. And when it comes to electronics, when it comes to conducting electricity with precision and reliability, there is no substitute for silver. Silver holds the highest electrical conductivity of any element on the periodic table. Copper comes close. But in applications where failure is not an option, where military systems must function flawlessly, where satellites cannot afford signal degradation, where medical equipment must perform without error, silver is not just preferred, it is required. This is why the proclamation classified silver alongside lithium, cobalt, and rare earth elements, materials that have already reshaped geopolitical competition over the past decade. But there's another layer to this story, one that connects directly to the economic forces already reshaping commodity markets. The proclamation explicitly acknowledged that demand for critical minerals is rapidly increasing and will continue to increase. Why? Artificial intelligence infrastructure, data centers consuming unprecedented amounts of energy, nuclear energy expansion, new energy technologies. Every single one of these growth sectors is silver intensive. A single AI data center requires thousands of ounces of silver in its electrical systems. Solar panels, now being deployed at record scale across the globe, depend on silver paste for photovoltaic efficiency. Electric vehicles, each one containing significantly more silver than traditional combustion engines. The math is unavoidable. Demand is accelerating, supply is constrained, And now, the US government has officially declared the situation a national security threat. But here's what makes this proclamation different from typical policy statements. It doesn't just identify the problem, it telegraphs the solution. And that solution involves something most commodity markets have never experienced: government intervention at the price level. The proclamation specifically mentions minimum import prices, a term that should make anyone paying attention sit up and take notice. This isn't about tariffs, which raise costs but don't set floors. This isn't about subsidies, which support producers but don't control markets. This is about the US government potentially becoming the price setter, the market maker, the entity that decides what silver costs, not through supply and demand, but through policy decree. And if that sounds extraordinary, that's because it is. When governments start competing with markets, when national security overrides price discovery, when strategic imperative trumps economic efficiency, the rules change, and they rarely change back. The proclamation that landed on President Trump's desk in October wasn't just paperwork. It was a warning, a signal that the era of free-flowing commodity markets, where price alone determined allocation, was coming to an end, at least for the 41 materials now classified as critical to national security. And silver, with its unique combination of industrial necessity, strategic importance, and supply vulnerability, sits at the very center of this transformation. The question is no longer whether the market will respond. The question is whether those watching understand what's about to happen before it does. There's a moment in every market transformation when theory becomes reality, when a policy proposal stops being an abstract concept and starts moving capital, reshaping industries, and forcing every participant to recalculate their position. The proclamation issued by the White House didn't just identify silver as a national security concern, it outlined the exact mechanism through which Washington intends to take control. And buried in the technical language, between references to negotiations and trade representatives, sat three words that change everything. Minimum import prices. Most people read past it, dismiss it as bureaucratic jargon, another policy lever that might never get pulled. But for anyone who understands how commodity markets actually function, those three words represent something far more significant. They represent the end of market-determined pricing. Here's how this mechanism works in practice. Imagine silver is trading globally at $90 per ounce. Supply and demand have reached equilibrium at that price. Producers are profitable. Consumers are purchasing. The market is functioning normally. Then, the United States government steps in. It declares a minimum import price of $100 per ounce, not as a tariff, not as a tax, but as a floor, a guaranteed payment to any producer willing to sell into the American market. What happens next isn't complicated. It's inevitable. Every silver producer on Earth, from Mexico to Peru to China, faces an immediate choice. Sell to the global market at $90 or sell to the United States at $100. There is no complexity here, no strategic calculation required. $10 more per ounce, guaranteed by the largest economy in the world, backed by the full faith and credit of the U.S. Treasury. The decision makes itself. Within days, perhaps hours, global silver supply begins flowing toward American ports. Refineries in Europe, manufacturers in Asia, electronics companies in Japan suddenly find their supply chains disrupted, not because there's less silver in the world, but because there's a buyer willing to pay more than the market price, indefinitely. And here's where the second order effects begin. Those same manufacturers, those same industrial users, they cannot simply halt production. They cannot tell their customers that products will be delayed because the United States decided to pay a premium for silver. So they do the only thing they can do. They match the price. If the US is paying $100, they offer $105. But now, the competitive advantage disappears. The US minimum price was designed to attract supply. Once that supply is matched by other buyers, the incentive vanishes. So what does Washington do? It raises the floor again. $110, $120, $150. Each increase pulls more supply into American markets. Each increase forces global competitors to match or lose access, and the cycle continues, upward, relentlessly, until something breaks. But what breaks first? And when remains the critical unknown. This isn't theoretical economics. This is exactly how strategic commodity interventions have functioned throughout history. The Soviet Union did it with grain. OPEC did it with oil. China is doing it right now with rare earth elements. And now, the United States is preparing to do it with silver and 40 other critical minerals. The funding mechanism raises its own questions. Where does the money come from to sustain these price floors? Taxpayer dollars? Almost certainly. Which means every American citizen becomes an indirect participant in a global bidding war for industrial materials. The fiscal implications are staggering. But from a national security perspective, the cost may be considered acceptable. After all, what price do you put on maintaining technological superiority, on ensuring defense systems function without supply interruptions, on preventing a foreign power from gaining leverage over critical supply chains? The proclamation offers no answers to these questions. But it does offer something else, a phrase that appears almost casually, wedged between discussions of negotiations and trade policy. Other trade restricting measures, 4 words, vague enough to mean almost anything, but in the context of critical minerals, in the context of national security, in the context of a global competition for strategic resources, the meaning becomes clear: export controls. If the United States cannot secure sufficient supply through price incentives alone, it can do what China did just 2 weeks prior. Restrict the export of domestically produced silver, prevent American-mined silver from leaving U.S. borders, force domestic production to serve domestic needs first, global markets second. This is the other side of the minimum import price mechanism. You attract foreign supply with financial incentives, you retain domestic supply with legal restrictions, and you create a controlled market, insulated from external shocks, prioritized for national security applications. The symmetry is striking. China implements export controls on silver. The United States responds by declaring silver a national security concern. And within weeks, a proclamation emerges that mirrors the exact strategy China just deployed. This isn't coincidence. This is strategic mimicry, economic warfare conducted through policy declarations rather than military force. And the battlefield, the contested territory in this new form of conflict, is the global supply of materials that make modern technology possible. Silver sits at the center of this contest, not because it's the most valuable, not because it's the scarcest, but because it's the most indispensable. You can substitute copper for some applications. You can engineer around certain rare earths. You can redesign systems to use less lithium, but you cannot replace silver in high-performance electrical systems. You cannot build advanced weapons guidance systems without it. You cannot scale solar energy without it. You cannot manufacture the electronics that power artificial intelligence infrastructure without it. And now, the US government has signaled its willingness to intervene at the price level, to restrict trade flows, to fundamentally reshape how this market operates. The mechanism is clear, the intention is documented. The only question remaining is timing. When does theory become execution? When do minimum import prices shift from proposal to policy? When do export controls move from possibility to reality? And for anyone positioned in this market, for any business dependent on silver-intensive processes, for any investor holding physical assets or paper claims, the answer to that question determines everything. There's a pattern that repeats throughout economic history, a pattern so predictable that once you recognize it, you can see it forming months, sometimes years, before it fully materializes. It begins with scarcity, not the dramatic kind, not empty shelves or panic buying, but the quiet kind, the structural kind, the kind that shows up in refinery reports and inventory data that nobody reads. Then comes recognition. Governments notice, industries start calculating their exposure, analysts begin writing reports that get ignored. And finally, there's the proclamation, the official acknowledgement that what was once a market inefficiency has become a strategic vulnerability. Silver just entered that final phase. But here's what makes this particular moment different from every other commodity squeeze in recent memory. The demand side isn't stabilizing, it's accelerating. The proclamation didn't just acknowledge current supply chain fragility, it explicitly stated that demand for critical minerals is rapidly increasing and will continue to increase. Not might increase, not could increase, will increase. That's not the language of cautious policymaking. That's the language of certainty, of inevitability, of systems already in motion that cannot be stopped. And the drivers behind this demand surge aren't speculative, they're infrastructural. Artificial intelligence. Every major technology company is racing to build data centers at unprecedented scale. Not thousands of servers, millions, not megawatts of power consumption, gigawatts. And every single one of these facilities, every server rack, every cooling system, every backup power supply requires electrical components that depend on silver's unmatched conductivity. Microsoft announced plans to triple its AI infrastructure capacity by 2027. Google is building data centers faster than analysts can track them. Amazon Web Services is investing hundreds of billions into computational infrastructure. Each gigawatt of new capacity translates directly into tons of silver demand. Not theoretical demand, physical, tangible, irreplaceable demand. Then there's the energy transition. Solar panel installations globally exceeded 400 gigawatts in 2024. Projections for 2026 suggest that number will surpass 600 gigawatts. Each megawatt of solar capacity requires roughly 200 ounces of silver. Do the math. That's millions of ounces being consumed annually, just in photovoltaic applications alone. And unlike other uses of silver, where recycling can recover the material, solar panels lock silver into a 25-year cycle. The silver goes in, but it doesn't come back out. Not quickly, not efficiently, not in quantities that matter to current supply dynamics. Nuclear energy presents another demand vector: small modular reactors. The technology the U.S. Department of Energy is betting on to meet future energy needs require extensive silver-based electrical systems. Each reactor, each cooling system, each control mechanism adds incremental but compounding demand. And these aren't distant future projects. Contracts are being signed now. Construction is beginning now. Silver procurement is happening now. Then there's defense. The proclamation specifically mentioned advanced weapon systems, hypersonic missiles, satellite communications, radar arrays, electronic warfare systems. Every modern military platform depends on silver's reliability under extreme conditions. And global defense spending isn't declining. It's expanding rapidly. The United States just approved a defense budget exceeding $900 billion. China is increasing military expenditures at double-digit annual rates. Europe is rearming after decades of underinvestment. Every dollar spent on advanced weapon systems translates into grams of silver consumed. But demand is only half the equation. Supply tells an entirely different story. The proclamation acknowledged something most market participants overlook. Even when the United States can mine critical minerals domestically, it often lacks the processing capacity to convert raw ore into usable material. Silver is the perfect example. Mines exist in Nevada, Alaska, Idaho, Montana, but processing infrastructure, refining capacity, supply chain integration, severely limited. Most domestically mined silver gets shipped to Mexico for refining, then imported back into the United States as a finished product. That's not a supply chain. That's a vulnerability masquerading as a supply chain, and it gets worse. 25% of global silver supply comes from a single country, Mexico, not distributed across multiple regions, not diversified among competing producers. One nation, one regulatory environment, one political system. If Mexico decides to implement export restrictions, if labor strikes disrupt production, if environmental regulations tighten, if trade relations deteriorate, a quarter of global supply becomes immediately uncertain. And the United States, despite having domestic mines, cannot compensate for that loss. Because mining without processing is like drilling oil without refineries. You have the resource, but you cannot use it. This is the processing bottleneck that the proclamation references, and solving it isn't a matter of months. It's a matter of years. Building refining capacity requires environmental permits, capital investment, technical expertise, supply chain integration. You cannot simply decide to process silver domestically and have it operational within a fiscal quarter. The timeline is measured in years, not months, which means for the foreseeable future, the United States remains dependent on foreign processing, even for domestically mined materials. And now layer in the geopolitical dimension. China, the world's largest processor of critical minerals, just implemented export controls on silver 2 weeks ago. Not a ban, but controls. Licensing requirements, strategic reviews, the kind of measures that don't stop supply entirely, but slow it down, create uncertainty, give Beijing leverage. And if the United States responds with its own export restrictions, as the proclamation suggests it might, then you have the world's two largest economies simultaneously restricting silver flows, while demand from AI, solar, defense, and nuclear sectors continues accelerating. That's not a market inefficiency. That's a structural supply crisis in formation. The proclamation's reference to price volatility wasn't a passing observation. It was a warning, because when supply is constrained, when processing capacity is limited, when geopolitical tensions rise, when demand accelerates across multiple sectors simultaneously, prices don't move gradually. They spike, they crash, they whipsaw between extremes, and the entities least prepared for volatility are the ones who pay the highest price. Small manufacturers who cannot hedge, electronics companies operating on thin margins, solar installers locked into fixed-price contracts. They don't have the balance sheet strength to absorb sudden cost increases. They don't have the supply chain redundancy to source from alternative markets. They don't have the strategic reserves to weather prolonged disruptions. So when volatility hits, and the proclamation suggests it will, they become the casualties, not through direct impact, but through an inability to adapt quickly enough. This is why the proclamation matters. Not because it creates the problem, but because it confirms the problem is real, structural, and accelerating. And in markets, confirmation is often the trigger, the moment when quiet concern becomes urgent action. There's a principle in strategic planning that separates successful organizations from reactive ones. It's not about predicting the future with perfect accuracy. It's about recognizing when the rules are about to change and positioning accordingly before the change becomes obvious to everyone else. The proclamation issued by the White House represents exactly that kind of moment. A documented signal, published in official channels, outlining explicit intentions, telegraphing policy shifts that will fundamentally alter how silver markets operate. And yet, most participants will do nothing. They'll read the headlines, acknowledge the concern, and wait. Wait for confirmation, wait for implementation, wait for clarity. By the time that clarity arrives, the opportunity will have passed. Because here's what history teaches us about government intervention in commodity markets. The announcement is never the beginning, it's the middle. By the time a policy becomes public, the groundwork has already been laid. The analysis has been completed. The political will has been secured. What remains is execution. And execution doesn't wait for market participants to adjust. It happens. And the market reprices accordingly, often violently. So the question facing anyone exposed to silver markets, whether as a manufacturer, investor, or strategic planner, isn't whether to act. It's whether you act now or pay a premium later. Consider the mechanics. The proclamation outlines minimum import prices, price floors that would artificially elevate silver costs above market rates. If implemented, those price floors don't arrive with a grace period. They don't phase in gradually over quarters. They take effect immediately upon policy execution, which means anyone who needs silver for production, for inventory, for contractual obligations, suddenly faces a choice: pay the new floor price or face supply interruptions. There's no third option. There's no negotiation with policy. And for businesses operating on margin compression, where input costs directly determine profitability, that kind of sudden price shock doesn't create challenges. It creates existential threats. Electronics manufacturers with thin margins, solar installers locked into fixed contracts, medical device companies with regulatory approval tied to specific component costs. They cannot simply absorb a 20 or 30% increase in silver prices. They cannot renegotiate contracts retroactively. They cannot redesign products overnight to reduce silver content. So what happens? They either secured supply in advance, or they suffer the consequences. And the consequences, in commodity markets under government intervention, are never gentle. Look at rare earth elements. When China began restricting exports in 2010, companies that had stockpiled inventory weathered the storm. Companies that waited for prices to stabilize paid multiples of previous costs. Some went bankrupt, others restructured entirely. The lesson was clear. When governments enter commodity markets as strategic actors, waiting for clarity costs more than acting on incomplete information. Physical silver offers something unique in this environment: tangibility. It's not a futures contract subject to forced liquidation. It's not a stock dependent on corporate performance. It's not a bond vulnerable to interest rate shifts. It's a physical asset, storable, fungible, globally recognized, and most importantly, immune to policy-driven devaluation. If the U.S. government sets a price floor at $100, your physical silver doesn't lose value. It gains a guaranteed buyer at that floor. If export controls restrict supply flows, your physical holdings become more scarce, not less. If geopolitical tensions disrupt trade routes, physical possession eliminates counterparty risk. This is the asymmetry that informed actors understand. The risk of acting too early is minimal. Silver remains a functional asset with industrial demand, monetary properties, and historical value preservation. The risk of acting too late is severe. Because once policy implementation begins, once price floors activate, once export controls formalize, the market reprices instantly, and that repricing favors those who positioned in advance. Now consider the corporate treasury implications. For any business with significant silver exposure, the procurement decision becomes a strategic imperative, not just an operational consideration. Hedging through futures markets offers partial protection, but futures contracts settle in cash, not physical delivery, which means if supply shortages materialize, financial hedges provide profit, but don't solve the fundamental problem. You still need the physical metal to maintain production. This is why sophisticated companies, those with experience navigating commodity volatility, distinguish between financial hedging and strategic stockpiling. Financial hedges protect balance sheets. Physical stockpiles protect operations. And when government intervention threatens supply continuity, operational protection becomes the priority. The timeline matters here. The proclamation was issued in October 2025. Implementation timelines for government policy, especially policy involving international trade negotiations, typically span months, not years, but not weeks either, which creates a window. A period between announcement and execution, where markets haven't fully repriced, where supply remains accessible at pre-intervention prices, where strategic positioning is still possible, that window is closing, not because implementation is imminent tomorrow, but because recognition spreads, first to institutional players, sovereign wealth funds, strategic reserve managers, and to large corporations with dedicated commodity teams, then to mid-sized manufacturers who read industry reports, and finally, to the broader market, when prices have already moved. By that point, the opportunity for advantageous positioning has passed. You're no longer buying strategically, you're buying defensively, at elevated prices, in a market aware of its own scarcity. The China factor amplifies this urgency. 2 weeks before the U.S. proclamation, Beijing implemented export controls on silver. That's not coincidence. That's coordinated strategic positioning by the world's two largest economies. And when both nations simultaneously restrict silver flows, while demand from AI, defense, solar, and nuclear sectors continues accelerating, the supply-demand imbalance doesn't resolve peacefully. It resolves through price, and the price resolution will disproportionately impact those who waited for certainty. Because certainty in markets only arrives after the move has already happened. The proclamation provided something rare in financial markets: advance notice, a documented signal from the highest levels of government, outlining explicit policy intentions, identifying specific materials, proposing concrete mechanisms. Most market participants will treat this as background noise. Another policy proposal, another government report, another headline that fades by next week. But for those who understand how strategic commodity markets operate, for those who've studied historical precedents of government intervention, for those who recognize that national security imperatives override market efficiency, this isn't noise. This is signal. Clear, documented, actionable signal. The question isn't whether silver markets will be disrupted by government intervention. The proclamation confirms disruption is intended. The question is whether you position before the disruption becomes obvious to everyone else, or whether you wait for certainty and pay the premium that certainty demands. History suggests those who act on incomplete information, when that information comes from official policy declarations, consistently outperform those who wait for perfect clarity, because in markets, perfect clarity arrives last. And by then, the opportunity has already been priced in,